Alright, investors. 2 days ago, I wrote an article about the cruise line industry, and in that article, I included 10 reasons why you should avoid the cruise stocks. Today, I thought it was a good idea to include those 10 reasons in a YouTube video. So, today, we're going to be talking about the cruise line industry and why you should not invest in these companies. Actually, lately, I've been checking other YouTube videos, and now that the cruise line, in this case Carnival Cruises, which is also the one we will be talking about mostly today, is below $8 a share, people are actually thinking that it's worth the high risk, high reward thesis. So in my opinion, it's still not the case, and today I want to tell you why. So let's start with the first reason. They have a high capex and they have a very low free cash flow. In this case, as I said before, we're going to be focusing mostly on the information regarding Carnival Cruises because that one seems to be the most appealing to everybody right now, and I really think you should not invest in this company. So let's go over their capital expenditures and their free cash flow. Here you can see their operating free cash flow in 2019 and their capital expenditures in 2019 as well, and that resulted in a 46 million free cash flow. Basically, the capital expenditure is as high as the operating cash flow, which leaves no free cash flow for the investors. And as you guys know, free cash flow is the cash that returns to shareholders, the cash that is generated, basically. So this is kind of an issue, the fact that they have such high capital expenditures, and they're also going to have that in the near future. If we look at their quarterly earnings, we can highlight this part, and here you see their capital resources, and on February 29th, 2020, they had a total of 11.7 billion of liquidity. Now, this seems like it will be, okay, we're very healthy because we have this amount of liquidity, but no, this is basically the part that is a loan to them. So they can borrow that money and then they can spend it. What they have decided here is that for 2020, they're gonna get 30 billion of immediate liquidity plus an extra 2.8 billion from 4 committed export credit facilities. That is a total of 5.8 billion. This 5.8 billion, they are gonna withdraw that money, meaning that it's gonna be a loan, and they're gonna use that to finance their capital expenditure in 2020. So they have already decided to take out a 5.8 billion loan to stick to their capital expenditures. That is very risky, in my opinion, because they actually need this money to finance their own business right now because they cannot collect any revenue. However, I believe that they have already committed to these cruise ships that they are buying, and they cannot get out of their contract, basically. And something else that was interesting is for the remainder of this 5.8 billion is for this year, and then you have 5.9 billion for 2021 and beyond, meaning that capital expenditures is not going to slow down in the next 2 years. So this recession that is basically coming, which will make people go on holidays less and less, regardless of that, they are going to be spending on new cruise ships, and I don't think that's the best idea right now. So, reason number 2, depreciating assets. As with most assets in a business that are on the balance sheet, they are depreciating. However, with depreciating assets, there is some kind of subjectivity to it. And what that means is that there is an underlying value, but if the situation of the world or the area that it's is operating in changes, so let's say it is less appealing, then an accountant can say, well, it is worth less right now. So what is happening, or what is possibly happening, that whatever value they have on the balance sheet right now is going to be lowered in the next few months just because the cruise line industry is not that appealing to many people right now. And even if it is appealing, they cannot use it. So there's a likelihood of depreciating assets. And if you want to know the risk, in their quarterly report of the first one of 2020, they mentioned this. The first quarter 2020 net loss includes 932 million of goodwill and ship impairment charges, reduced by net gains on ship sales. So what happened here is that, the way I read it at least, they had a loss on their assets, so on the goodwill and the ship impairment charges, and it was reduced by net gains on ship sales. So it was even higher, how it was, so the depreciation was higher, but they had some gains on the ships that they sold earlier, and that is why it is 932 million. So their depreciation has already been increasing, and I believe it will probably increase even more. And the reason why it could depreciate even more is because there is a lack of interest in cruises this year. So the accountant can just say, well, yeah, you thought it was worth 2 billion, but yeah, people are less on it, and it is unlikely that another company is going to buy this cruise ship for this value. So the fair value is actually lower than what you thought it was. So that is something to keep in mind if you want to invest in this company. They have a very high cash costs, and this is the cash operating costs. And yes, this is reason number 3. And if you look at this table, I guess, you can see the percentages of their total revenue and what it is in costs. This is this is the average cost of the 3 biggest cruise line industries. So Carnival Cruises is among them, and the other one is Royal Caribbean and the Norwegian cruise lines. And this was posted, I believe, at the end of last year, and it gives you an idea of the cost that they are making. I highlighted the costs that are probably still ongoing, and I see that I forgot to highlight the 11.6% of the corporate operating costs. But if you include these costs, it's going to be around 60% that they will still have to pay, even though they're not using their cruise lines. If you looked at the revenue of last year, which was over 20 billion, that means that they are going to have 12 billion, a little bit more, but let's say 12 billion in costs in a year if they cannot use it. So per month, 12 billion divided by 12 is 1 billion, so they have about 1 billion of expenses per month if they cannot reduce these costs. So sure, they can fire people, but that would mean that they would have to hire later on. So I'm assuming they're gonna have people fired, but these are the costs that you need to take into consideration. So if they are not cruising for 3 months, it will cost them about $3 billion. And that is what we're going to talk about in the next sheet. They have a very low survivability. Reason number 4. What do I mean with survivability? Okay, this is the cost that you have on a monthly basis. This is the cash you have. How long can you survive? So let's look at their cash position. It is 513 million. They have high cash costs. It was about 1.1 billion. But let's say 1 billion right now, it doesn't really matter that much. It's a big amount, of course, but it's not gonna change the survivability. So based on this information, they can survive for about 2 weeks. And well, as you know, they're on lockdown for more than 30 days so far, and it's probably gonna be extended. So they cannot survive, and they need loans. So how much money would they need? Well, let's say if they need 3 months, they will need to survive 3 months. They will need 3.3 billion. So that is something to keep in mind. On to reason number 5. The loans are necessary. They need to borrow money. As we just concluded, to survive 3 months, they need about a 3.3 billion loan. As of April 1st, which is right about the time where I finished my article, they announced that they are going to get a total of 5.75 billion in debt. And they are gonna, which it doesn't show here, but they're gonna gather money through offering shares of about 500 million. So they need basically $6.25 billion. This obviously will worsen the balance sheet, but something that is very scary about this part is the interest rate. Let's have a look. Of the 4 billion loan that they are gonna get, they have to pay an 11.5% interest rate, which is insanely high. This basically shows that the theory that financial education had about the banks won't let us go bankrupt because they would lose too much money really doesn't apply anymore. Why? Because if a bank would offer this loan, it wouldn't be as high. You know how the rates are right now. So they are looking at other people or other companies besides banks to get this money, and to make it appealing they have to put a very high interest rate, and that's basically what they did. They did it successfully, but 11.5% interest rate is really gonna ruin their income statement, but we'll get to that in the end. And besides that, the other amount, the $1.75 billion, has a 5.75% interest rate, and these are convertible notes. So that is far from appealing for the people that are shareholders. So keep that in mind. There's some more information here, so if you would like to read it, if you're still considering buying this company, I suggest you pause and then you take your time to get through this. So just to sum up, they offered 62.5 million shares, and they offered it at a price of $8 per share. That is, if you think about the fact that the company was trading at, what was it, $50 like 2 months ago, it is insane that they're going to offer stocks at $8 a share. This is really not great for any shareholder that is currently holding Carnival Cruises. And this basically, in my opinion, also shows that at this point they don't really care about the value of the shareholders. They just want to stay afloat. No pun intended. So this will basically get them another $500 million. So to sum up, they get over $6 billion. This really tells us that they think, at least management thinks, that they're going to need a lot more money to survive than just the cash costs. So all in all, it seems very scary. Reason number 6, increasing debt, decreasing EBITDA. So what's going to happen to their balance sheet? It is going to be less attractive because it's going to blow up. Their debt is going to increase, and these 6 billion, or let's say 5.75 billion that they're going to get in debt this year, there is no assets against that will make the balance sheet attractive again. So it's not like, okay, I'm going to blow up my debt or my liabilities, and my assets will grow at a similar manner. So in general, even that would not be the greatest for a company, because yeah, you get debt, but in this case it's just debt and no assets, and their current debt is like 11.5 billion, and they are going to increase that with like half just to survive, and they're going to increase it at an incredibly high interest rate. So it is awful. And next to that, their EBITDA is likely to decrease because of the people are not going on cruises that much anymore. So what that means is that the valuation method that people will use, okay, this company is undervalued, it is going to be worsened. Why? The EBITDA that should be increasing is decreasing, and the debt, which should be decreasing, is increasing. So whatever you thought before about, hey, this company is going to go, this company is undervalued, that might not be the case anymore the next time you're going to see their new balance sheet. Reason number 7, this is a highly cyclical business. That in general is not a bad thing, but you need to buy the highly cyclical businesses at the right time. At this time, if you look at their valuations, they had great profit margins, like over 12%, which is a great sign that the cyclical business is at its high end of his basically the economic boom. which we all know. So people have been saying, well, it's a great business, it has only been growing, and for 10 years you can see growth, the profit margins are increasing. Sure, they are increasing, and sure, right now if you do any valuation method, the price to earnings will look more attractive because their profit margins were more attractive. However, since it's a cyclical business, in the next few years, the profit margins will likely drop based on the fact that it's just a cyclical business. That in itself is not a great thing to be happening right now. So if you think, okay, this company has been growing and that's why I'm buying it, don't do it because it's cyclical and that growth is not going to sustain in the next few years, even if there was no outbreak right now. So be careful. And yeah, if we do hit a recession, which is very likely right now, it will cause people to choose less expensive holidays. And I think everybody knows that cruise line holidays tend to be very expensive. So to sum up, the best profit margin days are over. As I'm not going to stick too long with this one, as I think a lot of people have already covered this in their videos, they get no government aid. They are not based in the US or Europe, so they cannot expect any government aid compared to other travel related companies. So if you invest in one of these companies, you expect them to stay afloat on their own. As we just saw, they cannot. So they need to borrow money from other companies or at least not banks. Like if there's an individual that wants to lend them a lot of money, then sure, but it's going to be very hard for them to get the money that they need. We just saw that they were actually able to get that money, but at what price? Reason number 9. I have looked at all the companies, all these 3 cruise line companies, and they have a very low personal stake in the company. And now with a low personal stake, I mean management. With any company, you want management to have a high personal stake in the company. Why? That gives them an incentive to actually get the value of the stock up. And I don't mean just bonuses. No, they want to get it up for the long run because that's how they appreciate their own assets, in this case shares. So here you can see if they have a personal stake and if insiders have been buying the stock. And Carnival Corp, yes, they do have a personal stake, but it is less than 0.1%. Have insiders been buying? No. Royal Caribbean, do they have a personal stake? Yes, 0.5%. But not only have they not been buying shares, they have been selling in the past months. Very risky, because if they are selling, why would you be buying? They know far more than you and I together, or all of us investors together, because they are insiders. So if insiders are selling, be very careful. Norwegian Cruise Lines, yes, a 0.17%, also very low, and no insiders buying. They have been selling in the past year, so basically at the top of the cyclical part, like at the when the prices were very expensive, they decided to sell. So they are smart investors, I'd say. But they have not been buying back at this part, so at this time, so they think it's very... I can't think for them, obviously, but it doesn't show that they think it's undervalued right now. And reason number 10, the final bankruptcy, the final reason is there is no beneficial bankruptcy. And what do I mean with this? People might be thinking, well, if you look at their balance sheet, you see that they have shareholders' equity, so the assets minus their liabilities is like 22 billion, and the share price currently is 8 billion. So you have like 14 billion of profit if this company goes bankrupt. In general, yes, that is the case. You are buying the company at a cheaper price right now. But let's say they do go bankrupt. Will you get that amount of money? I don't think so. If a bankruptcy is going to happen, it is most likely going to be this year, and it won't happen if they stay afloat this year. It won't happen in the upcoming year. So this year is the riskiest. They have very expensive assets, and there is I don't know why it said a Y there, I'm sorry. There are very little buyers. If they go bankrupt, it would force a sell-off for far below the fair value. Banks will get paid first, and other bondholders, and that'll be the end of it. What does this mean? They just offered, what was it, 5.75 billion in bonds, in notes or bonds, however you want to put it. That means that they've added no extra assets to it, but they did add almost 6 billion extra in debt. That debt will need to be paid off first. If the current assets that are currently considered fair value, they have to sell that off, and basically for 30 cents on the dollar, because I think that is very likely to happen, because who's going to buy these cruise lines at this point? Nobody wants to invest in them. They cannot invest in them, the other companies, so they're going to be sold for a very cheap price. And that doesn't leave a lot of money. And if there's not a lot of money, that means that only the lenders are going to get paid and nothing is going to be left for the shareholders. So be very careful if this is the reason that you're investing in this company. So we've gone through the 10 reasons to avoid the cruise line industry. I just want to show you real quick what the impact is on their profit margin of the debt they just took on. It's going to be a lot of information in one click, so be careful, but here it comes. I will go through it real quick. In 2019, they had 11.5 billion debt on their balance sheet. They had to pay 206 million interest. What does this mean? It means that they had a 1.5% interest rate, give or take, on their debt. And this 206 million was about 2% of their total cost of revenue. That means that if they had, let's say, profits before interest, it would be 14%. If you take 2% off, then it would be 12%. So this affects their profit margin, which everybody is so excited about because, yeah, they have a great profit margin. However, what happened this year? They took on 5.8 billion extra debt to finance the capital expenditures, the new ships. I'm assuming that this will be at 1.5%. I think this is very low, but let's go on the safe side right now. That will mean that there will be an increase in their interest expense of 90 million. They also announced that they are gonna increase their debt by 4 billion because they need the money, and that will be at an interest rate of 11.5%. This will mean that they have a whopping 460 million extra interest expense for the upcoming 4 years. And the last one is the 1.75 billion debt at a 5.75% rate, which will approximately leave them with 100 million of interest expense. If you add this up, it'll come to 650 million. Well, add that to the current interest expense that they were already paying. That will leave them with an interest expense of 850 million, which is like a 400% increase of their interest expense. And this will mean that it will now not be 2%, but it will be 8.5% of their revenue. So if they manage to keep the same profit margins that they had last year, which was highly unlikely, and they're probably going to be loss-making this year, then instead of it being like 12%, it is going to be like 6%, even lower, 5.5%. And that is in the best case scenario that they keep revenue steady, which is not going to happen, and that all the other costs stay the same as well, which I don't think is very likely. So this is it. I hope you guys enjoyed it. I hope you guys learned something, actually. It's a bit longer again than I expected, but for some reason I tend to talk very long, and I hope in the future that I can take it down a notch. But for now, I wish you all a very nice evening, and in the next few days I will be researching other companies that are affected by the outbreak, and I will try to focus on travel industry because they have been hit the hardest. So we've gotten cruise ships right now, we've gotten the airlines, the European airlines, and I think I'm gonna focus on the booking companies because they do not have high high assets, or in general not that high of a costs. So that ought to be interesting. But anyway, I'm talking too long again. Have a nice evening, and I hope you enjoyed it. Bye bye.